Hey everybody, welcome to the Portico Podcast. This is Mike Casey, the founder of Portico Advisors LLC, and I'm pretty stoked about today's episode, which features a conversation with Tariq Fancy, the former CIO for sustainable investing at the now $10 trillion asset manager, BlackRock. He's also the author of the delightfully thought-provoking essay, The Secret Diary of a Sustainable Investor. I reached out to Tariq after reading his essay because it raises some uncomfortable truths about the explosion of ESG-related products across public and private markets. And while I agreed strongly with his writing about the nonsense of ESG-related investments in the stock and bond markets, I maintained that sustainable or impact-focused investors in private markets could still drive meaningful change. But I also wanted to think through whether the so-called greenwashing effect changes with scale. So I know managers, and this podcast has hosted managers whose investments are driving positive environmental and social change in some of the most underserved markets. And honestly, I worry that the asset gathering activities of large cap firms is not only going to crowd out the earnest players trying to increase human dignity, but also tarnish the idea that private markets investing can be a positive sum enterprise. I also worry about the proliferation of service providers bilking people with asinine accounting and compliance solutions, a phenomenon that famed corporate finance professor Aswath Damodaran refers to as the ESG gravy train. I remember reading an article in the FT over the summer about PwC looking to hire 100,000 people to provide ESG advice, and I thought, the madness must stop. We're creating entire categories of jobs that inhibit the flow of capital to productive users of financing. And we all know that scale providers can absorb these costs, thereby entrenching their market position and reducing competition from new entrants and smaller firms. So you can see why I was keen to speak with Tariq about these issues, as well as the roles that the public and private sectors can play in solving the structural, environmental, and social challenges of climate change and inequality. But we also talk about Tariq's nonprofit Roomie, which should resonate with listeners of the podcast. Roomie provides free digital education to learners in over 176 countries, including Afghanistan, where one of the big initiatives is to create more content in Dari and Pashto so that women and girls can continue their education despite the return of the Taliban. I'd encourage listeners to visit Roomie's website, and if you're a fund manager or institutional investor who's interested in supporting the growth of a nonprofit in the edtech space, reach out to Tariq and say hello. With that, I hope you enjoy the podcast. All right. Well, Tariq, welcome to the Portico Podcast. I'm extremely excited to speak with you today.
My pleasure. Thanks for having me on.
No, it's my pleasure indeed. So, I wanted to reach out to you after I read your quite witty and thought-provoking essay, The Secret Diary of a Sustainable Investor. But I thought to frame the conversation and to establish your bona fides for what's going to follow, I thought it might be helpful if you could just provide a sketch of your professional background and why you leapt at the opportunity to become BlackRock's chief investment officer for sustainable investing.
Well, so I started my career in a sort of a reasonably traditional trajectory of traditional meaning sort of for the banking and private equity space, where I started in tech banking out in Silicon Valley at CS. This is back in the days of when Frank Quattrone was running it. And then after the tech bubble burst, switched to the buy side doing distressed investing for many years, sort of 10-year long-term funds focused on turnarounds. Later built strategies at Canada Pension Plan Investment Board, which took me back to Toronto, which is where I'm originally from. And then, and I think the BlackRock opportunity found me in large part because I took, a break for a few years and founded Roomie, which is a 501c3 that uses technology to bridge access to learning around the world. Really starting in primarily in developing markets. And having done it over sort of 4 years and built it so it was in a bunch of countries and it had become a case study that HBS was teaching and so on, it kind of put me in a unique position of having then experience building both bottom lines, right? Mainly financial investing and returns as a private equity investor, but then also creating social impact from the ground up with technology. And that sort of balance led me to in the end to joining BlackRock in the role of the CIO for sustainable investing globally, which in some ways is or was thought to be sort of a merger of those things, right? You're trying to generate better investment outcomes at the same time as creating some kind of measurable social impact.
Yeah, totally. So, you recount in your essay a series of disillusioning and frankly, at times they just seem outright absurd interactions. But I wonder if there was a singular moment after you took the helm as CIO at BlackRock's for sustainable investing, where you had this epiphany that sustainable investing, which you bucket with ESG, responsible investing, or impact investing, is not only unlikely to help fight climate change, but it actually undermines the public interest. Or if it wasn't an epiphany, more of a gradual process.
I mean, it was largely gradual, but it was peaked by specific instances where, as with any of us, when you're learning something, sort of an insight, sort of a light bulb goes off and you start to pick up a piece of what becomes a broader conviction around an issue. And I think for me, the biggest ones were, while I was at BlackRock, sort of starting to realize that, ESG integration, which is a process enhancement that is sort of based on the idea that companies with better ESG performance, perform better, right? And then realizing that you generally it didn't really work across the board for most strategies, either because it was the wrong place to do it, because there's all these strategies that are short-term and liquid, and they just don't care about long-term sustainability issues because they're not paid to, right? The incentives aren't really there. Or the revelation that in some cases, the timeline does line up, but the fact of the matter is being irresponsible is profitable, right? I mean, and we know that that's the case, right? That's in large part why such large numbers of people, especially young people, have lost faith in capitalism as an economic system. And just looking at those revelations, and then some of the new products we were creating, which were really based, they seemed to be mainly marketing, and it wasn't BlackRock specific; it was the entire industry. I started to realize very quickly there wasn't a lot of impact in this. And that really, to create the kind of social change that we needed government regulation, which was really overdue in some of the most important areas. And I'd argue climate change is one, and inequality is the other. And we know what policy prescriptions to push, right? It's not like we don't have experts and economists telling us what to do. And so I think really the revelations were first those where I realized that this doesn't really seem to help at all, because it's really not the right answer to the set of problems that we have in society at all. This seems to be mainly marketing that doesn't have any real world impact. And I think the second big thing was after I left, I had not at that point decided to go and make a public argument around it. I left really, really good terms, transitioned out over 6 months, and had, and had turned my focus back to Roomie and educating people around the world. And it was really only the decision to start to go public really only came after I started realizing that it actually could be harmful. What we were doing wasn't just sort of a wishful thinking type of thing, or maybe greenwashing rather than greenwashing. It was actually actively harmful because the marketing messages around it were actually convincing people that we don't really need government regulation, right? And in that sense, if the experts are telling us that we need a price on carbon, we need a whole set of policy reforms in order to address these major societal threats, and ESG is not only not helpful, but is actively polluting the public discourse and convincing people that we don't need that, because there's this elusive win-win fantasy that that allows us to keep the status quo and create all the social change. You could see a pathway to saying that this is actually burning valuable time, and I think all of that trajectory really is kind of what led in the end to me sort of making the decision that something this important needs to be subject to an open and honest public debate in a democracy, and the sooner we have that, the better.
Yeah, man, there's so many angles to go right now, but the next step I'd like to take in the conversation is sort of like, you make really good points and convincing arguments that green investing in public markets via mutual funds or ETFs is nonsense. And like, you point to the portfolio manager, for example, who said, if ESG actually worked, we'd do it because my bonus would be better. The performance would lead to a better bonus for me. And it just hits you in the face that it is the most obvious statement of fact around. But there are several others that you make. But I do wonder if you think your argument extends from the primary markets where people trade shares, the secondary markets rather, where people are just exchanging shares, to the primary markets where investors' capital is being used to actually build things.
So that's a really important and interesting distinction. I do think that there are areas where impact can be created. I mean, I'll tell you, as you pointed out, I think the majority of what's being sold as an ESG or impact fund doesn't really have any real world impact, right? There's no additionality, right? Is a term from the impact space that, kind of says what you think it does, which is, is anything additional being created by doing this? Like if I invest in this fund, is something happening in the world that otherwise, wouldn't have happened? For the vast majority of the products in the category, people in the sustainable investing space will say, oh, there's a difference between ESG and impact and sustainable. Like I've seen 50 of these slide decks where they have all these arcane terms. The real world people don't understand them, right? The average person looks and says, well, I'm investing in this green fund, and they expect that something is happening in the world that wouldn't have otherwise happened, right? Their 401k money is going towards environmental and social causes or companies that are on the right side of that. And therein lies the challenge is the majority of the products, as you alluded to, they're just moving around baskets of shares traded in secondary markets, right? And so those are, sort of saying, look, there's already trillions of shares traded. We've figured out that socially conscious investors will pay a premium to have a little bit higher exposure to the nice companies and less exposure to the less nice ones. And so let's just go out to the market and collect a slightly different basket and give it to them at a higher fee. That doesn't change anything in the real world. The shares are already traded. And so I think, across the gamut of what are kind of considered ESG or sustainable products, there's a subset that does create impact. And those are the ones you kind of alluded to. It's where you're providing fresh primary funding and ideally to an innovator who's doing something that, that could create a breakthrough, right? So if you look at a climate tech VC fund, I think there's a really good argument to be made that there's additionality there, because if you didn't invest in that fund, that the innovator who's creating, some carbon capture technology or whatever, wouldn't have gotten the funding to do it. And so, you're actually doing something, that wouldn't have happened otherwise. I think for the vast majority of what's being sold as ESG products, including green bonds, there's no way to actually know that you're changing much because, behind the scenes, it just looks like money moving around. And that's one of the challenges, because the majority of what's being sold as sustainable investing by dollar value is, are the sorts of things that don't really have any impact. And, given the lack of regulation and the gray space on what any of these words actually mean, for a number of years, the EU is now changing that. But generally, given the lack of any understanding of what it actually means, there's a gray area where firms know that, if you put green paint on something, it's going to sell better, and no one's telling you, who can put it on and who can't, and what it actually means. And so you have sort of a bit of a race to the bottom where everybody wants to make a tiny tweak here or there that generally doesn't change the underlying product all that much, but gives them the maximum green benefit, because there's a chance for a fee bump and a competitive disadvantage at some point if everybody else is saying they're doing it and you're not.
Yeah, I was reminded of a dinner I was at in London one time where there was a collection of a bunch of self-proclaimed impact investors. And at the dinner, it was just this atrocious exercise in buzzword bingo with nobody defining the words, right? And there was one gentleman at the table who is investing in Africa, has been doing so for decades. And he just looked around and he said, what we're talking about is just investing. We're trying to build a product, a service, a good that people need in markets where they're not available, and deliver a financial return at the end of the day. There's no need to cover it up with all of this hokum, if you will. But I don't know if you have a reaction to that.
Yeah, no, I mean, I think I honestly, in large part, I think that's correct, right? I mean, if you look at everyone talking about ESG and how it's being used in their investment processes, all the big asset managers are sort of, being forced to articulate this. In a sense, they all will admit that they only look at ESG insofar as it's neutral or positive to returns. Why? Because, they have a fiduciary obligation to focus on, maximizing return and on dollar values, not social values, right? And so they're all going to say that, hey, of course we look at ESG. But then if you're reading the footnotes, they're non-binding because, everything they're doing, has to be within the risk return prism, all of which is fine, right? That's how the system works. And there's no surprise there. But then you almost wonder what's the big deal? Like, why are we even highlighting right? This, I mean, if you look at 100 data sets, right, ESG just happens to be one of them. And yet you find that across the industry, people are talking about ESG as this sort of like opiate to the masses of like this great solution that we've been waiting for. And then and you think about it, and you know, I'll tell you, when I looked at it, I was a trained investor and had a bit of a skeptical mindset, probably healthily skeptical mindset, because I'd done distressed. And I'd done a bunch of stuff in emerging markets and in places where, you know, you have to be very careful and verify the information you're getting. And it started to become clear to me, looking across the biggest pool of assets available in capitalism today, that you know, ESG was just not as valuable to our investing processes as the world believed, and as the industry had broadly was making out to people. And you know, and it started to become obvious to me that we weren't talking about ESG because it's this magical, wonderful data set that suddenly we've discovered and is, you know, is going to make investing better and make the world better and so on. The reason we were talking about it was because it included the words environmental and social at a time that every single data point shows that the public is demanding significant action on those issues. And that's where I started to get more and more worried, because I said, well, we know what the answers are, right? We have experts in society telling us it's all based on regulatory reforms. But you know, we also know that the system is reflectively anti-taxes and anti-regulation. And as a capitalist, you know, I don't love taxes and regulation, but you know, I love that more than the planet getting destroyed and inequality eating up our political systems, right? And so at some point, you know, the game needs rules, and those rules need to be updated. And ESG, in large part, seem to be, you know, have a kernel of truth. There's no question it's a kernel of truth in certain areas, but you know, it was quite limited, and it was being pulled out and put on a pedestal and, you know, used as a marketing tool in a significant number of ways that that really just, in my view, were creating this large placebo, right? That was, you know, slowing our response to the challenges we have.
Yeah. So I want to pick up on two of the threads there. The first being the sort of ENS box ticking exercises, and the second is the demand for environmental and social products. And so you have this comical anecdote of Bill McGlashan and TPG's Rise Fund in the essay. And when you're talking about it, you sort of emphasize the point that ESG had become this surface level box ticking compliance activity. And it's something that Aswath Damodaran at NYU says is accruing to the benefit of this ESG gravy train. And you know, our last episode was on the downfall of the Abraj Group, which had wrapped itself, just like TPG Rise, in this profit with purpose narrative. It received numerous good housekeeping stamps of approval from prestigious institutions, all whilst allegedly committing fraud, right? To the tune of hundreds of millions of dollars. But even when there's not criminal activity, the impact investing landscape's becoming larded with mega cap buyout firms like Apollo, Bain, Blackstone, KKR, et cetera, all raising vehicles because A, there's demand for profit with purpose, and B, they're not going to turn down the opportunity to grow AUM. So there's just like a lot of BS in the space, in impact investing space. But at the same time, I know investors that are trying to say, bring financial services or renewable energy, you know, to underserved markets. So is there a way that people should think about separating the good from the grifters? In your estimation, is it even worth trying to do so?
You know, it's interesting. I think there is some value in doing it, because again, there are certain products that do have additionality. I think the challenge is that, you know, as you stated, you know, it's hard to figure out what they are a lot of the time. And the space seems to have evolved in a way that it's kind of interesting. I mean, the sense I got was that the impact investing space has existed for like 20 years, right? I mean, it had been around for a while, but it was a small niche space that was generally managers that don't really have a lot of investment experience, and it's a lot of sort of, in some part, wishful thinking, right? You'd always see these like things where they'd say, "Oh, our returns are just as good as, you know, anyone else," and then you'd look into it, and you know, the details would show that that's probably not true, and there was some potential concession. And generally, the managers weren't that good. I mean, you know, I remember like 10 years ago, there'd be folks like, you know, the average impact fund I'd see would be like more of a nice story than anything else, right? It'd be like some former Ashoka, fellow who's created a $5 million fund to invest in farmers in Kenya. It's great. It's a nice idea, but you can't see institutional capital going into those, right? Because the average limited partner really can't. It's not going to pass the diligence requirements because the investors don't have a track record and so on. And the sense I got was that in the last like 6-7 years, the big firms saw an opportunity to do it, right? And they were less interested in impact. They were better investors, but less interested in impact. And so the Apollos of the world kind of went in, and there's no surprise there that was really just an asset gathering strategy, right? If they can raise more funds at 2 and 20 with whatever strategy, it's impact or this X or Y or Z, they're probably going to find a way to do it because that's how their business model works. And in the end, you end up with a situation where, somewhere in there's some interesting funds, but the vast majority of them are not really doing anything that different than they otherwise would do. I mean, the sense I always got from Abraj, which fascinatingly is a place that I interned for 6 weeks as an MBA student in 2008.
Oh, no kidding.
Yeah, I obviously had not seen that it was going to go in the direction it did, 10 plus years later, but there were definitely warning signals with the culture. I mean, it was an 8-week internship from INSEAD, which, only gives you 8 weeks. And between you and me, I cut it short after 6 weeks. I was like, I got to get out of here because it was clear to me that I wasn't ever going to work there. I was interested in doing it because I was interested in emerging markets stuff, and this was a way to spend some time in Dubai and get a lens into that. But what was interesting about that was that the sense I always got from them was that even when it came to impact investing, they weren't doing anything different. They just sort of realized that, wait a second, like healthcare in Africa, if we go and invest, there's probably some additionality, and we're probably providing capital to build infrastructure that may not otherwise exist. And if we can measure some kind of outcomes, against that, then it's just a marketing benefit, right? But that's the challenge, right? For the most part, it's things that already exist getting spun as an impact thesis, not because there's really much of an impact thesis, but because society is demanding action on these issues, particularly younger people, increasingly, because they know well that they're going to bear the consequences of an action today. And the answer, it has to be regulatory reform, right? I mean, it's the referees. And because we live in a world where, since the 80s, I think there's been a set of narratives that underlie the system and convince people that free markets solve all problems, and there's so much money in politics and other things. There was no reform coming of the type we needed. And there was, I would argue, sloth on the part of regulators in large part, just watching things happen that they should have been policing, which, by the way, is going on today with NFTs and a whole set of other things that are considered innovation, but likely to be scams in the long term, that rip off people. And, in the absence of that, it's like a sports game where if the referees really don't exist, or just not doing their job, but people are saying that the game is getting dirty, the only option then available, or will start to become available and obvious to people, is this idea that, well, we just have to self-regulate and self-police, and, good sportsmanship on the part of athletes is the only answer that really seems to be left.
Yeah. So you do this really well in the essay of connecting this concept of good sportsmanship, like the good sportsmanship behavior of elites, to the persistence of these structural systemic problems that are really like cancers in our society. But, just to push back a little bit, as I was reading the essay and I was questioning, should we be giving up on the private sector as an equal agent of change, whether that would be prudent? And so 3 things came to mind. The first was, I thought about, well, first you want democracy to actually be able to affect change. But in the United States, we often see gerrymandering, entrenching vested interests, and reducing the ability of democratic elections to actually serve their purpose. But then, even if you have democracy, are the regulators going to push through reforms that are conducive to what you want to see happen? And so, for example, then I thought about Europe, where government regulators are trying to change the rules of the game, but they're pushing through like insanely burdensome compliance requirements that are just going to cement the dominance of large, deep-pocketed firms, and exclude smaller, firms from trying to do these things. And then the last piece is, well, what if it's a non-democratic country? Like, can the private sector in those markets step in and provide goods and services that enhance human dignity in a way, and well-being, in the absence of the democratic process? So I don't know, are those Are those fair retorts, or am I missing the forest for the trees here?
No, those are actually all very fair. I mean, I would say, look, I think, so first off, I'd say that I think the private sector, not only does it have a role to play, it has the major role to play in solving social issues. This is an important point because I think a lot of people will hear me saying, well, we need government regulation. And they'll say, but what about the private sector? Can't the private sector, or would the finance industry has to be part of it? That's almost a straw man response I've gotten a few times from people. It's not what you said, but I think some people say, oh, well, what about the finance industry? Of course, don't they have to play a role? Of course, finance has to play a role, right? Of course, the private sector has to play a role. I mean, it's most of the capital and jobs in the economy are in the private sector. I'm a capitalist, right? So there's not a question to me that the business is going to play the major part of finding the solutions we need. I think the word government comes in is not as, there's a difference between government as provider and government as regulator. So I'm not talking about government as provider, right? Of like sort of, government, they tax you and they create the school system, right? And that's obviously beneficial to all of us, right? But I'm not talking about a government creating electric vehicles. It's more of government as regulator of saying, listen, even if it's totally revenue neutral, we are able to set up the incentives of the system to incentivize things we need more of and disincentivize things we need less of. And I think that's the area where the private sector can play the key role, but it needs those signals from government, right? It needs to signal to say, listen, the answer to lowering or flattening the greenhouse gas emissions curve at the speed we need it, flattened, frankly, won't be ESG and voluntary compliance, because we know there's a market failure, and that, unless we correct that market failure, in any event, there's no question that the economists are telling us through their models that that's going to result in more usage of fossil fuels than we need to happen as a society. And so that's where you need, someone has to internalize the externality. And that's where I think, so that's where government plays. It's really just giving the signals to the private sector to sort of then allow a greater capital allocation. I think those signals need to be mandatory, not voluntary, right? Given the scope and the nature of the problem. And I think within that, I do think then that there's a lot of room for the private sector to innovate. And I think that the private sector will have to think more and more about ESG issues, not in the way it's been thought of so far, right? It's largely marketing, but I think in earnest about sort of, particularly emerging markets where the regulatory regime is going to be less advanced. There's a lot of scope to do things in different ways. I think, there's always going to be an importance of stakeholder capitalism, in some form, and businesses changing the culture of how they operate. But I also think that for the most important things, climate change and inequality, those, I think, you just can't rely on the free market to self-correct, right? The market is going to have to obviously play a role, but it's going to need the guidance of policy reform in order to move it, in the direction at the speed we need it to move in.
Yeah, here. No, I tend to agree with that framing of it in terms of changing the rules for the commons, right? So that the game that we're all playing is aligned with future generations' survivability on the planet, and without falling over a cliff of internecine conflicts that are bubbling beneath the surface right now. So I don't know if you're familiar with these ideas, but after finishing the essay, I was reminded of Raghuram Rajan and Paul Collier's recent works, where they independently sort of reached a similar conclusion, and that's that the governance challenges that are besetting democratic countries are partly a function of scale, and that we need to sort of devolve power and authority down to more local levels. And the challenge is, of course, we face this gap between the necessity of strengthening local legitimacy and the need for massive coordination to confront the transnational challenge of climate change. So, I mean, I don't know how this gap gets bridged, and I don't know if you have any thoughts on it, but it just occurred to me when I finished the essay. I thought I'd throw it out to you, since you're a smart guy who has clean thinking skills.
And just to clarify, you're sort of thinking in terms of, in particular, climate change, the challenge of sort of national level agreements, and then figuring out internationally how to coordinate everyone.
Yeah, and it's even more than that, because the pressure is that we need even more localized governments, say in the US. And so rather than the US going and Joe Biden meeting with some other head of state to do a transnational thing, it's, well, how do we get 50 states or cities or municipalities all having more legitimacy than their national governments, right? But getting all of those more local governments together to solve this human-wide challenge.
It's an interesting one. I think local governments obviously have been doing quite a bit in certain areas of the U.S., just obviously in the absence of any kind of federal, um, aggressive climate plan at the federal level. You've seen cities and states acting, California and so on, um, trying to do things that, ahead of everyone else. I think it's an interesting question in terms of, the level of government. My sense is that the way that it's going to need to get done, and again, this is just my opinion, but it is probably that the US at the federal level is going to need to take a significant leadership role. Obviously, that's going to require a whole set of political challenges, and what looks increasingly like a fairly dysfunctional political system, as well as sort of coordination at the local level. But it's funny. I can't see any avenue to getting a significant climate deal done this decade without U.S. leadership. And it's funny. I'm a Canadian. I grew up in Canada and went to school in the U.S. And the average Canadian is like not always dying to, sort of keep putting the U.S. on the pedestal, or sort of looking, again and again to the U.S. for leadership and to sort of save the world. But I don't see any avenue around that, because I think that if the U.S. were to lead today at the federal level, I think that there's a bunch of political challenges that obviously exist, but let's just imagine those you can get past those. Then I think you can sort of get some deal that runs across the country in some form. And I think that if the US were to lead, you would be able to create a block of Western countries, because I think the EU is not, they're already kind of trying to do it on their own. And so it makes it much easier for them, frankly, if the Americans are doing it. The Canadians are going to always follow, right? I mean, the challenge in a place like Canada, which I'm sure is replicated in Australia and other similar size countries, is that you can't really get a deal done when so much of the industry is somewhat carbon intensive, unless you can at least show that it's international, right? Otherwise, people in Alberta or in places that have a lot of resources sort of say, what's the point of us doing it alone if, no, the big countries aren't involved? And I think the final thing I'd say is that the biggest challenge there is that I don't know that the politicians have the leeway to do it today, because there's so much money in politics. All of the short-termism that I'm worried about in business, where the incentives are very short-term and, people aren't paid to care about long-term sustainability issues. Those are arguably replicated in politics also, right? I mean, the electoral cycle is also short. But on some level, my goal is to turn to the business community and spark a debate and tell them, listen, politicians have short-term cycles, so do business people. The difference is they're increasingly begging for money, right? The first question, I have a friend who wants to run for Congress. I mean, first question that they get asked is, how much money can you raise, right? And so the difference is that they both have short-term cycles, but the politicians are begging for money and the business people have it. So on some level, I think the real debate that needs to happen, and I think that could fan out and create change globally, is if the U.S. business community had a serious discussion about what responsible business is. And that's, I think, it can't be a smokescreen that, sort of squeezes out near-term shareholder returns at the expense of the long-term public interest. And because if that's what it is, it doesn't even serve the interests of the younger employees at places like BlackRock and other firms, right? Because I think they're increasingly looking at it and saying, we're at the bottom of the totem pole, and we gain the leads from the status quo, and we're most going to get stuck with the bill of the consequences of inaction. And I think that's sort of an intra-business community debate that needs to happen more and more.
Yeah, totally. All right. So on this issue of sparking debate, let's wrap up the discussion of the essay, and then we'll turn to what you're working on in the future. But I've seen some great write-ups, particularly in the FT, around your essay. But I'm curious more broadly, what's been the reaction to it, and is it accomplishing what you hoped it would?
Well, I'll take the second one first. I mean, I think what I hope to accomplish was to spark a debate, right? And I think on that level, it does seem to be doing that, which I'm happy to say is sort of starting to occur. And the reaction, honestly, it's interesting. I've gotten a ton of inbound, and it's almost all been positive. And in particular, I think it's interesting that a lot of the folks that I used to work with in industry, investors really on the buy side, or bankers or whatever, they're all sort of saying, whispering that, like, listen, we agree with everything you're saying. And yet they don't really feel comfortable saying it out loud publicly, because, appearing to be anti-ESG, it's this weird virtue signaling thing where it's like, oh, how can you be anti-ESG? That means you're, anti-society. Obviously, I'm trying to smash that consensus and say, well, ESG doesn't actually have any value. So, it's actually slowing us down. If you're progressive, the even if you believe in the ESG thesis, you can't, you should be pushing regulation even harder because it arguably creates the investment thesis behind ESG, or burnishes it at least. And so I think that, the sense I get is that, people aren't often comfortable being able to say it, because if you're at a firm or you're working in the ESG space, you can't say what I'm saying in the same way that I couldn't say what else, the stuff I'm saying now while I was still at BlackRock. But there is this rumbling underneath the surface because everybody kind of is starting to accept that it doesn't really make any sense. And, the ideas behind it are unfortunately, they were well intended, but it's, again, at best, it's greenwashing, right? That's slowing us down. And to be honest, I haven't really seen a serious, people are talking about it, but there hasn't really been a good response from the other side, right? I spoke at a conference here in New York yesterday, and one of the most fascinating things is there was a fireside chat at the conference where I talked about ESG. And the conference organizers mentioned to me that they went around, they wanted to make it a debate because they thought this would be, entertaining to people. And they couldn't find anyone else to take the other side of the debate. And they said the reason was that when they would talk to people, everyone kind of whispered and said, we kind of agree with a lot of what he's saying. And so no one wanted to take the other side. And obviously BlackRock has not responded or in any meaningful way, or Larry Fink hasn't. And so it's this interesting place where I think the paper and the argument it's kind of like, it's now spread like termites, kind of breaking right at the foundation, but it hasn't yet collapsed. But I have to say it probably is going to sooner than later, because there's only so long that the fantasy can persist when everyone kind of is forced to accept that, the hard truth is that it doesn't work, and we need tougher medicine to create change at the speed we need it.
Yeah, well, a room full of institutional investors is not a place to find people who are willing to embrace career risk. So I'm not terribly surprised at that. All right, so you've left the world of asset management ostensibly for good after this essay. But so why don't you tell us a little bit about Roomie, what you're seeking to accomplish with it? What do you want to do with it? And then what can listeners do to support your new initiative?
So Roomie was almost, in many ways, is predicated on an early investment I'd done like 15-ish plus years ago around bringing mobile phones into emerging markets, right? And so, my parents were born and raised in Kenya. I'd been there for generations, and I was always interested in international development. And the term impact investing didn't really exist back then, but it was just a great investment where we realized that the handset costs had come down to $50, and you could build an infrastructure to allow people to leapfrog over the absence of landlines and go straight to mobile phones. Obviously, in retrospect, that's been this watershed moment in international development, a great investment, as well as creating a lot of impact by building key infrastructure that's now used for financial transactions and healthcare and so on. And in many ways, Roomie was based on a similar idea, which is that everything we learn under the age of 18 is available for free online today, right? It's almost easy to take for granted the fact that, like, I remember the days in 20 plus years ago where encyclopedia salespeople used to go door to door, and it would be like $1,000 to buy these things. And now, if you were to mention that to someone from Gen Z, that think it's insane, right? Because that stuff is just all free online. And the data showed, when I was starting Roomie in 2013, that there was this utopian view of the sort of TED Talk level of grand thinking, where people said this explosion in free learning content and the ability to learn free online is going to have the greatest impact in the least affluent communities, right? Where there's been the greatest sort of lack of access to learning. And yet the data actually showed, and still shows in many ways, that it's actually increasing educational inequalities, because the people who have the most to gain are the least likely to access it. And so that was really the founding mission behind Roomie, was how do we bring the free digital learning revolution in a way that's easy, fun, and free to girls in Rwanda, girls in Afghanistan, kids in Detroit, right? The ones who have never had equal access. And that was really it. And so we grew it over a number of years. I stepped back, and it was, the team is great and sort of spends their time running it, and building it. And so I'd stepped away when I was at BlackRock, and they kept growing it. And now the solution is used in over 200 countries. And one of the most important ones that we're focusing on, going into the holiday season this year, is around digital learning for girls and women in Afghanistan. We had started programs in 2017 to allow, a girl to learn from anywhere safely on a mobile phone. largely because 20 years ago when the Taliban were last in charge, there were no mobile phones. And so if they shut the school down, there's no other options for girls to be able to learn, right? To sort of recognize their basic human right to an education. And now over 80% of people in Afghanistan have access to a mobile phone. And that's the infrastructure that we're using now. And we have local language learning materials in Dari and Pashto, right, that we've been using now for a while. And going into this fall, the goal is to help people in the country, but I think specifically women and girls who are, really traditionally have been denied access there, to continue learning, right, even under a new government that is directly and indirectly going to curtail their rights. The one thing that government can't do is prevent them from learning safely from anywhere on a mobile phone, which is totally free. It's totally easy, and it skirts all of the social barriers that exist. And since we've been doing it for a number of years, I think our biggest focus now is just really, doing a large sort of growth of those programs and finding partners to help us grow them so that we can cover more subject areas and expand distribution to millions in the country, working with the mobile operator as one of our partners. And I think, it's one of those things where it was already needed, but then everything that happened in August in the country laid bare the fact that, we need to scale it up 100 times now. Otherwise, there's an entire generation of people who fought hard to get rights to learn and educate themselves that are seeing that really just unjustly wrenched from them in real time.
Yeah. And I noticed that you have a partnership with Roshan, you mentioned.
That's right. Yeah.
Yeah. Awesome. Yeah. Well, I'd encourage people to go check out the website, and I'll be sure to include links to everything and links to the support page. But one of the things that I also love about this platform is the bite-sized content. And, on the one hand, like, there's the gamification piece to it, but on the other hand, it's appreciative of the realities of data capacity constraints and how much people have to pay for data usage.
Yeah, the micro learning bit is really interesting because in some ways, some of the early data are showing that in North America, the English language version is actually competing with social media. It's taking time away from social media because it turns out you get a dopamine rush from learning a discrete skill or concept, in 5 or 6 minutes with one of our micro courses, which is the exact same, the average Instagram session is 6 minutes. You get a dopamine rush for that also. The problem is, over time, that's bad for your mental health. And, we're trying to use the engagement mechanics of social media to provide value to users, right? Only collect their data insofar as it makes it a better learning experience, and to, really create value for the learner over time. And, rather than sort of detracting from them, which has been generally what people have gotten addicted to on their mobile phones.
Yeah, you're here. All right. Well, Tariq, this has been awesome. I don't know if you have any closing comments or a place that people should reach out to you if they're inspired and they want to get in touch and give you some secret messages about their deep thoughts about ESG, but I'll turn it over to you.
Yeah, there's not really a place for it yet. I think if anyone's interested in Roomie, just our website has a bunch of materials. Easy, go to roomie.org, rumie.org, and you'll see actually the English language micro learning that is actually spiked significantly in the pandemic. So we've added like 100,000 learners just in the last couple of months, and it's accelerating. So there's that. And I think, there's information there on how to support our work in Afghanistan, or people can just reach out to me on Twitter or through Roomie. And, I'm happy to chat, and really excited to get folks who really want to particularly grow the social impact piece of what I'm doing, because I'm seeing in real time some really tough stories from our partners on the ground, and I'm really focused on how we can. That's really ESG, you might argue, in some sense, right? It definitely has real impact. And so there's a way to do something good there now for people who need it.
Yeah. Well, terrific, Tariq. This has been great.
Thanks for having me.
My pleasure. Have a good one.
You too.
Hey, everyone. This is Mike again. Thank you for listening. I hope you found the conversation edifying. And if you have any feedback, good or bad, please send me an email at mike@porticoadvisors.com. If you like this episode, please share it with a friend, colleague, or your connections on social media. Or, if you feel like it, leave us a review on your podcast player of choice. If you're keen to learn more about private markets developments across the emerging markets, then go ahead and smash the subscribe button, and please visit our website, porticoadvisors.com. That's porticoadvisers.com, where you can peruse through our research and newsletter archives and sign up for our monthly-ish newsletter. Ciao for now. The discussion in this podcast is for informational purposes only. Neither Portico Advisors LLC nor its guests plan to update this material, and the opinions and conclusions mentioned may change without notice. Neither Portico Advisors LLC nor its guests make any warranty that the information in this podcast is error-free, omission-free, complete, accurate, or reliable. Nothing contained in this podcast should be construed as legal, tax, securities, or investment advice.